Hi, I'm Bill Wilt of Assured Research. Thanks so much for joining this quick hit video where we focus on one research note drawn from our November 2025 Assured briefing. This note is on specialty insurers. Title of the note is Valuations and Growth are Normalizing. Happy to share this with you. I'm going to work on sharing the screen while I just say that if you want to poke around at our YouTube site, learn more about the research that we produce, it would be our pleasure to share our work with you via a trial. So let me do this. Sharing, and there, that should do it. So specialty insurers, valuations and growth are normalizing. Two parts to this note. One is a focus on market share changes over the last 8 years, I guess that is, in the specialty E&S non-admitted space, and part two is a look at valuations and growth, valuation parameters for the publicly traded companies and growth prospects and how they're changing. This kind of summarizes part one. It tells the same story, the graph on the left and the right. What I want you to focus on is the meaningful changes from 2016 to 2024 in the market share held by the top 10 groups or unaffiliated companies, mostly groups, the next 15, and everybody else. You see a change happening in the upper left. The bottom right really brings it home. And what you see is the top 10 companies have lost, that's about 18 points of share since 2016. The next 15 companies, so from 11 through 25, have kind of held serve. And that means that among all the other companies, they've picked up about that 18 points of share. I have a few other interesting anecdotes on how the market has changed. I just share the 18 points of share lost by the top 10, mostly gained by those formerly outside the top 25. But E&S specialists, which for purposes of the report we defined as companies writing with more than 50% of their premiums from non-admitted, admittedly a broad definition, but going with that, those companies, so those who are specialists, more than 50% of their premiums from E&S, they now control 22% of the E&S market. That's a tripling of where their share was in 2016. So some really consequential changes. This title of this note might have been referred to as the rise of the specialists. But we also make the observation that we think that this, 2024, maybe the first part of 2025, really represents the peak of those changes. And I'll save the punchline until we get to the end. But market share changes, part one. Part two is we looked at the valuation parameters around the publicly traded companies. The work underlying this is a valuation model called a residual income valuation model, if you're interested. But the point is that it allows us, it's a model of 4 specialty insurers on the left, 4 standard, mostly or almost wholly admitted companies on the right, mostly admitted companies on the right-hand side. Specialty versus standard, 4 companies each. The residual income is a valuation model we have that allows us to model the company's earnings and kind of sort of understand the expectations built into the public valuation of the companies. We actually try to tie to or reproduce the next 2 years worth of consensus estimates for premium growth, underwriting profitability, net investment income, the main parameters that drive companies' earnings. We try to match those as best we're able using consensus estimates for the companies, and from there make decisions and choices, a lot of which are highly subjective, but consistently, as we've done this work now for probably this is the 3rd year, I would guess, you draw the same conclusions, and that is the specialty insurers draw much more of their market capitalization, their perceived value, from PVFP, the present value of future profits. So the specialty insurers, about half their value is drawn from their current equity, and then the other half, 52% in this case, drawn from the red and the black together. Let's just call the present value of future profits. Compare that to the standard companies. 2/3 of their value is drawn from their equity. Only then 1/3 of their value drawn from the present value of future profits. So clearly, the specialty insurers are expected to grow faster, probably be more profitable. And part two of our valuation work here says, yes, that's true, but the gap is narrowing. When we look at in the blue bars, the historical gap or difference between the specialty and standard writers, and historic meaning the past 10 years, so 2015 to 2024. Take, for instance, premium growth. There was like a 13 or 14 point premium growth differential over the last 10 years. But when we do our valuation work, again, much of which is subjective, but at least in the near term, trying to anchor to that which reproduces consensus estimates. We show that in the future, the next 10 years, that gap is likely to be much more narrow. Similarly, with the combined ratio, the difference larger, 6 or 7 points there, let's call it, in the historical period, still fairly substantial, maybe a 6-point difference. Net investment income, not much difference. And the ROE gap, they had about a 5-point favorable ROE gap in the historical 10-year period. That's forecasted to narrow. So specialty insurers expected to retain many of their historic advantages, but the gap is narrowing. And that's really not surprising. And we'll kind of bring these 2 points together and the conclusions forward. The E&S growth in the E&S market is expected to kind of begin to normalize, and you see that in the recent data for some of the specialty insurers. But it seems likely to us that some of the gains by the E&S specialists over the last now almost decade are really likely to slow. Whether they'll reverse or not, we don't know. But the observation is there's an awful lot of capital sitting in companies that were the former, going back 10 years ago, were the former leaders in E&S. And they still have, there are a lot of names you would all recognize. They still have substantial E&S capabilities. And with organic growth slowing, with the pricing cycle, now hitting softening phases in most lines of business, it just seems logical to us that these companies, the former powerhouses in E&S, aren't going to kind of sit back and watch their market share erode further. And then the other observation is that the financial differences between the E&S companies and the standard groups seems likely to narrow because of fundamental characteristics of the markets, but also because lots of standard companies now have fairly substantial E&S capabilities. So it feels to us like some of the lines are blurring within groups, blurring between E&S and standard, at least as to financial results. So that's what we had. Hope you enjoyed this and found interest in it, even if you don't agree with everything. But if you don't, feel free to let us know. And if you'd like to see more of our work, just please reach out. We'd be happy to start you on a trial to it. Thanks so much.